Welcome to Academic Gain Tutorials. In this video, we will discuss about the difference between dividend stocks and REITs. Number 1. Dividend stocks represent ownership in a dividend-paying company, whereas REITs represent ownership in a real estate-focused trust or company. Number 2. Dividend stocks can operate across many different industries, whereas REITs mainly focus on income-producing real estate. Number 3. Dividend stocks generate income from company profits paid as dividends, whereas REITs usually generate distributions mainly from rent and property income. Number 4. Dividend stock payouts are decided by the company's management and board, whereas REITs are often required to distribute a large share of their taxable income. Number 5. Dividend stocks usually offer moderate yields that vary by company, whereas REITs often provide higher income yields, although they also vary. Number 6. Dividend stocks can offer stronger business-driven growth potential, whereas REIT growth is often tied to rents, acquisitions, and property values. Number 7. Dividend stocks can provide broader sector diversification, whereas REITs are concentrated mainly in the real estate sector. Number 8. Dividend stocks are mainly affected by earnings, competition, and market sentiment, whereas REITs are mainly affected by occupancy, rents, property values, and debt costs. Number 9. Dividend stocks are affected by interest rates but often less directly, whereas REITs are usually more sensitive to interest rate changes. Number 10. Dividend stocks are backed by the company's overall business assets, whereas REITs are backed largely by tangible property assets. Number 11. Dividend stocks depend on the company's pricing power to deal with inflation, whereas REIT rents may provide a partial inflation hedge. Number 12. Dividend stock prices move with the stock market and company news, whereas REIT prices move with market trends and property cycle expectations. Number 13. Dividend stock taxation varies by country and account type, whereas REIT distribution tax treatment can differ and may sometimes be less favorable. Number 14. Dividend stocks are best for investors seeking income plus long-term business growth, whereas REITs are best for investors seeking income plus real estate exposure. Number 15. The typical goal of dividend stock investors is to build passive income with diversified equity growth, whereas the typical goal of REIT investors is to earn steady income while adding property diversification. So, in simple words, dividend stocks combine company ownership with income growth potential, whereas REITs combine real estate exposure with an income-focused approach. On the other hand, dividend stocks may offer broader diversification and stronger business growth, whereas REITs may appeal more to investors who want property-backed income and real estate sector exposure. For educational purposes only, returns, taxes, risks, and regulations may vary by country and investment type. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.